An SBA loan can be one of the most powerful tools a small business owner ever uses. It can help you buy real estate, acquire a business, expand operations, or preserve cash. But if the loan is structured wrong, or if the business is already tight on cash flow, that same SBA loan can become a serious problem. In some cases, it can almost bankrupt the business it was supposed to help. SBA loans are attractive because they give small business owners access to financing that may not otherwise be available. Lower down payments, longer terms, and bank support can make a big opportunity feel possible. A business owner might use an SBA loan to buy a warehouse, purchase equipment, acquire a competitor, or expand into a new location. On paper, it can look like the perfect growth move. But approval does not mean affordability. Just because the bank says yes does not mean the business can comfortably handle the payment every month. The mistake usually starts with optimism. The owner assumes revenue will grow, expenses will stay controlled, customers will pay on time, and the expansion will work exactly as planned. Then reality shows up. Insurance increases, taxes increase, repairs cost more than expected, payroll grows, vendors need to be paid, and customers may take 30, 60, or even 90 days to pay their invoices. The loan payment does not care whether the business had a good month or a bad month. It is due every month, no matter what is happening inside the company. That is where the pressure begins. The owner may start using cash reserves to make payments, then delay vendor payments, then rely on credit cards or lines of credit just to keep the business moving. The business may not be failing because it has no revenue. It may be failing because the debt structure is consuming the cash flow. This is the part many business owners miss. A company can be profitable on paper and still be running out of cash. Profit and cash flow are not the same thing. A business might show income because invoices were sent, but if the cash has not been collected, there may not be enough money in the bank for payroll, rent, taxes, repairs. That is why debt service coverage matters. The question is not just, can we make the payment? The better question is, can we make the payment during a bad month? Can the business survive if revenue drops 20%? Can it survive if a major customer pays late? Can it survive if equipment breaks, insurance increases, or a project gets delayed? If the answer is no, the loan may be too tight. A good deal should not require everything to go perfectly. There's also the personal guarantee problem. Most SBA loans require the owner to personally guarantee the debt. That means the risk does not always stay inside the business. If the company cannot repay the loan, the owner may still be personally responsible. That can affect personal assets, future borrowing ability, and long-term financial stability. An SBA loan is not just a business decision. It is also a personal risk decision. The SBA loan itself is not the enemy. The problem is using leverage without enough margin for error. Before signing, a business owner should stress test the deal. Use conservative revenue, higher expenses, slower collections, repair reserves, and realistic operating costs. Do not build the model around the best case scenario. Build it around the hard months because those are the months that expose weak deals. Used correctly, SBA financing can be a wealth building tool. It can help a business owner buy the building they operate from, stop paying rent, acquire a cash flowing business, or expand without giving up ownership. But the structure matters. The payment, down payment, amortization, working capital reserve, collateral, and personal guarantee all matter. The best borrowers do not only ask, can I get approved? They ask, can my business safely carry this debt? SBA loans can help build stronger businesses, but they're not free money. They're leverage, and leverage magnifies both good decisions and bad ones. Used wisely, an SBA loan can create long-term value. Used carelessly, it can turn a growing business into a cash-starved one. Before taking the loan, understand the payment, protect your cash flow, and make sure the business can survive when things do not go according to plan. Because the loan that helps you grow should never be the loan that takes you down.